Hello and welcome to the How to Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling. Hello and welcome to the How to Exit podcast. Today I'm here with Patrick Stroth. Patrick Stroth is a trusted authority on executive and transaction liability. His firm, Rubicon Mergers and Acquisitions Insurance Services, is a member of the Liberty Company Insurance Brokers, a nationwide network of insurance brokers focused on middle and low middle market companies. Patrick is a pioneer in applying rep and warranties insurance to lower middle market M&A transaction. He and his team are committed to help lower middle market owners, founders, and investors achieve a clean exit. Patrick is the host of M&A Masters Podcast, where he speaks with leading experts in mergers and acquisitions. Thank you for being on the show. And I have you here today because you've got this real cool, innovative product that exclusively set up to insure deals from $1 million to $20 million. Let's just jump right in. Thank you for being here.
Yeah. Hey, Ron, it's my pleasure. Thanks for having me today.
All right. And for those you guys out in the live, this is live cutting on Raw. When you see the finished version of it, I'll have a cleaner version of his intro there. So we were just talking about this ahead of time. Sometimes I make it through there nice and smooth, and sometimes I trip over my own tongue. But let's focus.
I have podcasts too. I do the exact same thing. It's rare when it gets out perfectly, but we're off and running.
Cool. I don't want to let everybody know, but in 100% clarity, I practiced it 3 or 4 times before you came on camera. So that's even worse. So I got it better the first 2 times than I did just then. So let's just jump right in with you. What got you started in M&A, like mergers and acquisitions?
Yeah, so I'm an insurance broker by trade. Got out of college, went right into insurance, and did everything from home and auto all the way through commercial insurance. I found a real passion for the complexity and just the intellectual challenges with executive liability. This is directors and officers liability, employment practices, professional liability, things like that. It's a lot more interesting than home and auto. I got pulled into mergers and acquisitions because one of my policyholders is a doctor, and this is about 5-6 years ago. He had 6 companies. He was bundling them together, and he was selling them to a healthcare conglomerate for about $50 million. And I had asked the doctors, were putting the insurance together just to, have it run off and so forth. I just said, so what are you going to do with the money? Where are you going, Doc? And he said, well, I'm going to the old country, which was Israel. So he was going to be, after the merger, after he sold his company, he was going to leave the country and go off to Israel. When the buyer found out that he was leaving the country, they changed the terms of the deal and they said, look, this isn't personal. We don't mean to be adversarial, but we got to hold back half the money, okay, for at least a year or 2, because you know what? If you leave the country, we have no way of clawing the funds back. So I'm afraid we have to set this up. So they were going to hold back 25 of the $50 million in an escrow fund for, I think it was probably more than 2 years. And so the doctor came to me and said, Patrick, seriously, there's got to be a way we can insure this transaction. And I said, well, there is a way, but it's prohibitively expensive. And he just said, price is no object. And when a lot of clients in insurance tell you price is no object, they're sincere until they know the price. And it's a really big object. And all of a sudden they said, no. Well, this is late 2015, early 2016. And this product for insuring mergers and acquisitions is called Reps and Warranties, had just undergone a great reduction in rate. Okay, it went from a rate where this was probably going to be $1 million plus policy to less than half of that. I was shocked when I put together the proposal for the doctor that for a couple $100,000, he was going to be able to exit. And instead of leaving with only half his money, he left with 49 out of the 50 million in his pocket. And when I saw the power of a product that can go ahead and enhance an entrepreneur to exit with almost all their money, and not only exit with the money, but get to keep it, because if there was a post-closing breach, the policy would respond to the buyer. The buyer did not have to come after the seller. So he was free and clear and got out. Eventually, he would get his holdback of that $1 million. That was the deductible, and moved on. And when I saw that happened in real time, I pivoted the practice of our firm to add in this this product called Reps and Warranties Insurance. And essentially what it does, for those that may not know, it's probably the biggest thing in private equity today. But what it does is it steps in the shoes of the seller and enables the seller, who ordinarily they make a bunch of disclosures about their company to the buyer, and the buyer performs due diligence on the financials and the legal, et cetera, just to see how accurate those disclosures, or what we call reps and warranties, are. And based on the buyer's diligence, they're going to go ahead and say, great, well, we're going to move forward and purchase your company. However, we can't diligence everything. So if something pops up that we didn't know about or you forgot to tell us, we've got a provision in here called the indemnification provision that allows us to claw back some or all of the money from the purchase, okay, if the discrepancy is big enough. And we want to be able to claw that back. Well, what the insurance industry did, and actually there's natural tension in here, because you got a seller that's, looking at the buyer saying, hey, I told you everything. If you didn't find it, that's not my problem. The buyer is looking, saying, wait a minute, this is market, and I'm sorry, but we have to hedge our bets on this. And so this is what everybody does. And so you just have to take it. Well, the insurance industry came up years ago and said, look, show us these disclosures. Okay. Buyer, show us the diligence that you perform to verify that the accuracy of these disclosures. If you did a good enough job on the diligence, I'll tell you what, for a couple bucks, if there is a breach, we the insurance companies, not the seller, will pay the buyer's loss. Seller gets out from under, and usually not only do they get to exit with a very small holdback or escrow amount, usually is 10% of the purchase price. Well, now it can be as low as 1%. Not only do they exit with more cash closing, but they have assurance that they get to keep their money, because, like I said, if there is a breach, the insurer, not the seller, covers the buyer. And it's also helpful for the buyer for a number of reasons, because this is a way to get the deals moving forward. Now, this is, rep and warranty just in a real thumbnail. The thing is, these are really good and efficient for $100 million deals, because buyers at that level are going to do extensive diligence. They're going to get legal diligence. They'll get quality of earnings, audited financials, things like that. Okay, which is great. But that's not available for smaller deals. And so that's been the real gap out there, is what do you do with a company that is maybe under $10 million in value? Okay, where's their protection?
So this original product was for like larger deals. You were saying $100 million deals, and it's very common in that space, right?
Yes. Yeah, it was reserved initially just for $100 million plus enterprise value deals. It has over the years come down to 75, then 50 million, then 30 million. And so, I mean, they're writing policies now for $25 million enterprise value deals. The challenge, though, is, if you're a private equity firm, are you going to spend, several $100,000 to $1 million to diligence a deal that's probably, 25 million? It's a lot easier. The bigger buyers have the leverage, so they can essentially tell the, and I've had clients come to me, sellers come to me saying, Patrick, we've heard of this rep and warranty. We'd love to do it. We'll pay for it. Tell the buyer we'll pay for it. Just, can we get it? And the buyer's just going to sit there and say, look, I'm sorry, it's cost prohibitive for us. We just can't do it. And so that's where there's been that gap until now. And this is why I'm so happy to be with you today, is because there's a very innovative insurance firm called CFC. They're a London-based insurance firm. Very good reputation in the reps and warranty space for the traditional deals. And they looked out across the pond and they said, look, there are 1,000 times as many small micro deals as there are these regular deals. These are smaller Main Street companies that have very little risk. They're pretty straightforward. And you know what? We're not seeing a lot of big claims on the big deals. So why don't we make a volume play and make a simple, broad product that is inexpensive, so we can go ahead and start getting these, scores and hundreds of deals that happen every single month. And so they've come up with a product. It's called TLPE, Transaction Liability Private Enterprise. And it's designed for companies with an enterprise value of not more than 20 million. They can write an insurance policy that can cover up to $10 million of the enterprise value. And we've got several cases now where sub $10 million deals, we just insure them for whatever the purchase price is, and we move forward with that. And it's the newest innovation out there that is beginning to gain momentum. But as with a lot of things in insurance, getting the word out is a challenge. That's why I'm happy to be here with you to talk about it today.
So in the bigger policy, you guys have audited financials, you got legal due diligence, you got a whole team spending
Yeah.
tens of thousands, if not hundreds of thousands or more, verifying that transaction. And then the insurance company reviews that, right? In this
Mhm.
case, what is the application process, or what is needed? Is there still audited financials and stuff, or what's the subset that a business owner would need to present?
That's a great question. I'll tell you, we're going to break it up between the TLP and the traditional. Okay, traditional rep and warranty. There's no application. Essentially, what the underwriters do is they want to get a draft copy of the purchase and sale agreement where there's a list of what the reps are. We then ask for the reports that the buyer had. What diligence reports did you do a quality of earnings report? Did you do a tax report? Human resources, legal diligence, all operational diligence, all those types of areas of focus that were performed. Okay, and then based on that, the underwriters will look at that and put out a proposal that says, okay, well, if we were to dive into this and really go through this, we figure a policy of X amount of coverage is going to cost Y amount of premium. And before we get into this, we're going to need to hire an outside counsel to look over the due diligence and actually vet it. Okay, that's called an underwriting fee. That underwriting fee is routinely between $35,000 and $60,000. So out the door on a traditional policy, you're going to be paying $30,000 to $60,000 just for the underwriters to go through their whole process. That process can take about a week to 2 weeks. There are some people that say they can do it in days. It takes a week to 2 weeks, and then that process moves forward. Now let's contrast that with TLPE. TLPE is a straightforward application process where, again, this is a simpler thing. And what underwriters are going to do is they're going to go through, they're going to ask, instead of underwriting the buyer's diligence, they're going to look at what the seller can tell them, because nobody knows a company better than the seller. The owner and the founder knows a company best. And so what the insurance underwriters are going to do, they're going to rely on the seller being honest, which is typical for every insurance policy. Fill out this application as best you can, and based on your industry class code and the size of the deal, they'll go ahead and evaluate what the risk is, and then put out a price. And the great thing about this is there is no underwriting fee that's necessary, and so forth. And I could step back a little bit on TLP and how it's different from the traditional rep and warranty in this way. And not to get too into the weeds with the coverage, but a traditional rep and warranty policy, the policyholder is the buyer. The intent of this rep and warranty is so the seller gets a clean exit. If the buyer suffers a loss, buyer goes to the insurance company to collect. Okay, so it is on a format called a buy-side policy. Under TLPE is what we call a sell-side policy. It is not dependent on the buyer's diligence at all. It is just dependent on the quality of the policyholder or the quality of the seller and their business. They review an application. They review the current financial statements of the seller. They would look at the letter of intent just to see just format on the structure of the deal, and then they will put out their terms. And the terms, this process, because it's finite, it's not going to cover every type of deal. The process is on an accelerated platform, because the intent is underwriters want to write hundreds of these a month. And if you have a cumbersome multi-stage process for quoting and evaluating, it's not going to work. And so they wanted a streamlined process, and they've put together a process that, essentially that from beginning to end can take literally 2 days to get these things done. So it works out very, very nicely.
Now, have you guys already worked with like the Small Business Administration loans and the typical ways people fund the LBOs? Just
No, we haven't been in that. Usually at the size that we're looking at right now, we've got buyers that are funding, either with a loan, not necessarily SBA loan or anything like that. We don't get too involved in the financing process of the transaction itself. What we're going to look at is we're looking to protect the seller. And in this vein, when you protect the seller, you're also protecting the buyer, because there will be a source of remedy for the buyer should there be something that blows up.
Yeah, I guess you're right. Because unless there's real estate involved, they're not going to go above that into that range. They're going to stay below the $10 million range.
Usually, yes. And honestly, where we like to see this is, this doesn't have to be limited to just individuals or families buying and selling companies. This is going to be very big, we believe, for private equity, where private equity has strategies now where they're looking to get a platform portfolio company and then add on to that, and just, rather than get organic growth, grow through, doing add-ons and bolt-ons. And those add-ons and bolt-ons are the ideal, type of risk that our underwriters are looking for, is that, the sub $10 million to $15 million SaaS company that gets, bolted onto a larger platform. That's where we like to be.
So a lot of times these earnouts are tied to not just risk based, which I can see the insurance policy tying, but the new acquirer wanting to keep a particular member or members of the team around, kind of like it's an additional golden handcuff. So I can see this policy kind of keeping people truly honest in the transaction, right? Like,
yeah. I'm sorry to interrupt and jumping in on you, but I think that's just a real key issue here. And we see this in Silicon Valley a lot, is that one of the great benefits for rep and warranty, particularly on the TLPE, because you've got a much smaller, seller there that's intimately, involved with the company and could be transitioning over, and they don't have a lot of bandwidth to lose money. And so it gets very, very uncomfortable if, let's say, post-closing, there is a loss, and you have a real uncomfortable situation where the seller is a key member of the new team coming over and is waiting for their holdback or their escrow to mature and collect. And then the buyer's got the unenviable task of going out and breaking the news that it was outside of everybody's control, but this happened, and that $1 million you were waiting for, yeah, I'm sorry, we had to use it here. We've actually seen situations in Silicon Valley where you bring on some rock star programmers, and there's a real dilemma there for the buyer. Do we, alienate these people who are just great contributors, or do we just eat the loss? And what's real convenient and elegant about reps and warranties insurance is that, if you've got that third party that has very deep pockets, bring them the claim, they're going to pay the loss. And it just makes it very simple across the board for everybody.
I can see where that would be a real problem, right? You're working there, you committed to being there for the next whatever. I guess I'm hearing between 3 and 5 years on earnouts these days. And then something goes right, and they're either going to try to claw back money from you while you're sitting in the chair, or not deliver to you what you're expecting. So I can see this actually, helping with one of the key reasons why a lot of these acquisitions fell, and that's integration, right? Something happens throughout the integration policy, and you can't keep people engaged and active and make things mesh together. This, I could see reducing some of that friction that causes that failure to integrate.
Oh, I think that let's step back a little bit and just look at M&A in general and situations here, because this is really where overall reps and warranties is coming in really contributed to the parties, and how I would say probably about 90% of private equity deals now involve some form of reps and warranties. And here's what happens in mergers and acquisitions. You've got two parties. You got one party that's very experienced, that's the buyer, and then the seller is usually inexperienced in the whole process. Okay. And it's not anybody's fault. It's just that if you're in the business of operating a company, you're operating the company. Okay. When you're private equity or other buyers, your business is buying. So you're used to this. And so there will go through these processes where, you know, the buyer is going to ask for all this information before they make a decision. The seller, I mean, it can be, in their opinion, a very invasive process going through this whole diligence process. Okay. And the buyer keeps coming up with more things to ask and more things to look at and so forth. And the seller is going through this whole process thinking, you know what, I've opened up my soul to you. I mean, there's nothing more I can tell you. And the buyer and the buyer's just sitting there saying, look, I understand you've told me everything. You've been very helpful, but you know what? I'm being asked to make a, you know, millions or tens of millions of dollars bet on you that your memory is perfect. So I'm sorry, we have to go through this. And then the seller finds out, you know, because they're not used to this process, is once they go through that whole thing, their attorney sits them down and talks to them about indemnification. That's that whole clawback issue. And then the seller's reaction is, wait a minute. So I've told you everything. And even if you miss something, I'm still on the hook. Wait a minute. And so there's this distrust that happens. And it's just a dynamic that goes through. And unfortunately, you know, if circumstances are the way they are, you've got sellers cornered and they're going to reluctantly move forward. And, you know, they're going to lose a lot of sleep, and hopefully the deal goes through and nothing happens. And, you know, they move forward. Well, you got reps and warranties comes in, and that's just taken away from the two parties. And I can tell you, I mean, this is what's been great about having this TLPE for smaller deals. The very first policy that CFC wrote is one that we were very proud that we were reached out to. But you had a SaaS company, $5 million enterprise value. Okay. The buyer was a portfolio company, a very, very sizable bank. And the bank had within the provisions, they said, look, it's a SaaS company. If there's any intellectual property breaches, we want to retain full control. We're going to use our attorneys to fight anything like that. Now, this bank had very expensive attorneys, and the sellers were looking at that saying, wait a minute, you can burn up to the full purchase price on your attorneys that are going to be very expensive, and we're on the hook for it. We could lose the whole $5 million. Absolutely not. Deal died right there on that point, because the bank wasn't going to back down, and the sellers were quite frankly like, we're not writing a blank check for you guys. Okay. Within a day, they had heard about us with the TLPE, reached out and said, is this possible? We were able within a couple days to insure the full $5 million value of the SaaS. We put in a provision that it was simple. The bank had full authority to use whatever attorney they want. They could incur whatever legal costs up to the policy limit, which was $5 million. And they were set. All of a sudden, seller, the worst they were going to lose is $50,000. That was the deductible. That was it. Okay. Moved forward on the deal and got it taken care of. And those are the types of cases that we really like, because we want to come in where a seller is very vulnerable and they've got nothing to hide, but they need to get this. And the buyer has a legit concern and they want to hedge their risk. And so how can we bring that product for both of them? And that's what TLPE does.
I've actually had a personal case where we made an offer, and one of the things we'd like to put in our offers when the due diligence was okay, but there's some unknown things, is we give a 45-day walk back clause where we can walk back the whole process and hand you your company back in 45 days.
Wow.
And I've had some huge pushbacks from companies where we were looking at it, we sat down, we made them the offer, and, you know, this one of them was kind of a turnaround deal. It was a very low offer. We just pretty much offered to take over the huge debt they had, and not in huge, and it was $4 million. So they were close to $4 million in debt. We were going to take that over and take a company that they're trying to shut down and bring it back to life. And the thing that they bugged them more wasn't the kind of dollar down deal where we give you a dollar down, take your business and pay your debt off over the next 3 years. That didn't worry them as much as, what do you mean you can give it back to me in the next 45 days? Right.
Yeah.
And I know this wouldn't apply to that just because of like I said, everything wasn't clean is why we had to make that offer. But there's a lot of cases out there where, you know, the buyer has some gut feeling that there needs to be that clawback, there needs to be some type of I can't even say the word today, indemnification. Yeah.
It's part of our daily lexicon. So, yeah.
So you know, there's gonna be times where that's just like there's natural pushback. I can see a huge win for this. And when we were talking on the phone before the show, I had heard of the R&W, or the risk,
Rep and
warranty,
warranty.
rep and warranties, that for the big deals.
Mhm.
And I just never heard that there was anything for the smaller deals. Like, do you have examples of other examples you mentioned earlier, like the SaaS company? What are some other deals where that's actually it helped the deal get done?
Yeah, I mean, we have one right now where we had a situation where it was another technology company, but you had a husband and wife were divorced, and so they want to be able to split the proceeds from the sale of the business and then move on with their lives. And so again, this was another one of those situations where it was unique. It was under $10 million, and it went forward. We just this week, a wholesale performance glove company. They distribute high performance gloves for the outdoors. They got purchased by a sporting goods apparel company. Okay, $1.4 million. I mean, small deal. Okay, we were able, and the concern there was just, there's going to be a holdback of 10%, so it's $140,000. Is there anything we can do on a deal that size? And so we came in, we looked at it, we could insure the full purchase price, $1.4 million, cost $20,000. That was the premium. Okay, and we can talk about pricing later. But for 20 grand, that holdback went from 140,000 to 14,000. That was the deductible. Policy attaches right over that. And the buyer just said, look, I'd love to work with you, seller. And it's not that we're afraid of it. It's just the way we do things. We have to have this holdback. Okay. Well, once that holdback got covered with the insurance, they were fine. Another, consumer electronics company is on the table this week. $6 million purchase price, and they don't want the holdback of 600,000. Okay. Bring in a policy that's maybe a little over $65,000-$70,000, but their holdback goes from, they go from collecting 5.4 million at closing to 5.9 million at closing. I mean, it's pretty good. And so those are the types of things that are out there. Okay. And I guess if you were to ask, okay, well, what kinds of companies are eligible for this? Okay. Criteria for TLP, enterprise value has to be under $20 million. Okay. Originally it was under 10 million. We, modified it a bit, but it's got to be under 20 million, just because the underwriters figured the complexity level accelerates exponentially above that threshold. So under $20 million. We are looking for Main Street types of businesses. These are light manufacturers, light technology, retail, hospitality, restaurants, franchises, and, all those types of businesses. You see business services that are, on Main Street. Those are the types of companies that are being sought. There are other companies that insurance agencies can be purchased and covered under this. We mentioned light manufacturing, heavy manufacturing, just the environmental is too big. Pretty much the only things that TLP can't accept are highly regulated businesses and larger deals. Okay, so anything in the energy sector, healthcare sector, where you got a lot of regulatory, banking, those unfortunately are not available. That leaves the field wide open out there. Okay. And the two most common questions I get: number one, how much does it cost? Okay. TLP and rep and warranty premiums are priced based on not the size of the deal, but they're priced based on how much insurance you get. Okay. Usually the minimum limit on traditional rep and warranty is a $5 million limit policy. Parties are usually looking for anywhere from 10 to 20% of the enterprise value for buying insurance there. On TLPE, they can go all the way up to $10 million in limits to match whatever the enterprise value. Okay. So unfortunately you can't insure a $5 million company for 10 million, but you can get it to 5 million. Or if, the parties say, look, we got $1 million holdback. Okay. We just write the $1 million limit and do it that way. Okay. The premiums are running between now $10,000 to $20,000 per million in coverage. Okay, so you can have a policy. Now the absolute bottom rate is $15,000. So the minimum premium is $15,000, but then it goes from there to $10,000 to $20,000 per mil in limits that are needed. The deductible is 1% of the enterprise value, so you'll have that deductible in there, and there is no underwriting fee. So, I mean, the expenses of this are very, very low. The second most common question I get is, okay, well then who pays? And as all things are in mergers and acquisitions, whoever has leverage in the deal pays. Okay. With TLP, it is a sell side policy. The seller is the policyholder. So very often the seller will be funding this thing. The buyer just says, look, you're either going to go with the traditional 10% holdback or you get the policy, okay, at your expense. We are seeing many, many cases where buyers are very cooperative with their counterparties, and they've agreed in the last two deals I've had, the two parties split the cost evenly. So whoever pays does not matter, gets paid at closing and goes through that process. But again, when you get into reps and warranties on the traditional side, you're looking at minimum premiums of $250,000, $300,000 plus underwriting fee, plus taxes, plus. This is a great, again, elegant, ideal alternative that's now available in the lower, I call it now the micro market.
So inside of these policies, what's covered and what's not covered? I mean, what exactly is insured in this structure?
That's actually a basic question. Everybody, wonders on that. Okay, the TLP policy. We're just going to say TLP here. TLP policies are triggered when the seller receives a demand from the buyer saying, there is a breach, we have suffered financially. It doesn't even have to be a breach of the reps. It can just, you misrepresented to me that X, Y, Z it was accurate. Okay, we suffered a loss. We are now looking to you to collect. Okay, so the scope of the policy is usually just within those reps and warranties, and the policy gets brought. So those are fundamental reps on ownership, anything, financial reps, tax reps, operational reps. If we've had cases where the seller forgot to disclose to the buyer that a bunch of their equipment was leased. Okay. And so, the question just didn't come up, and that can happen in a lot of these fast moving deals. And the buyer brought an action because they lost $50,000 of value because of those lease agreements. Policy paid. So there are those type of things. So what we're looking for is these are demands from the buyer against the seller. That's what's covered. What's a little bit easier and gives us a little bit more credibility is, on insurance policies, what's not covered. Okay. First of all, if there's anything known that the seller knows about, it's not going to be covered. The seller is aware that they're about to get audited, not covered. If the seller is aware, well, we've got some problems out of, this little corner, if you know about it, if it's been disclosed, it's not covered. Okay. And that's going to be true of every insurance policy out there. With TLP, which is unique from other things, is that financial reps, and most companies in the TLP range are not audited. Okay. If, however, they represent to the buyer that their financials are they're in accordance with GAAP standards. Okay. If they're not audited, that's not a legit rep, because you are not a GAAP standards if you're not audited. Okay. So any kind of representation to GAAP standards is not going to be covered. Okay. If there are the TPP loan issues, things of those areas, underwriters are not liking those. Condition of assets is another big limitation on the coverage. Okay. This policy is not here to be the warranty policy. So if you're selling your equipment and the equipment or the inventory isn't up to whatever you represented and the value is actually less, it's not going to cover that. Okay. And then finally, exposures that are better insured elsewhere. Okay. Specifically, we're going to look at things like cyber liability. If there was a cyber breach or whatever, okay, that is insurable through a cyber policy that's separate. Okay. If there's an environmental issue or some other kind of exposure that is covered by a regular commercial policy, those aren't going to be covered by TLPE. TLP will then take on any of these unknowns that'll pop up post-closing.
So it sounds like you'd pair this with some type of general liability policy.
Yeah, well, you would look at that. I think that happens if you are a professional service, for example. They have types of policies that are called claims-made policies. You would buy a tail that would extend the policy reporting period for a claim for years post-closing. That's routine. This policy would go parallel with that and go that way. And then other trips and falls. If something happened pre-closing, that's going to be on one policy. If it happens post-closing, that gets picked up on TLPE.
And then we've talked quite a bit about, like, these policies are equated on the value of the company. Is that the valuation, like what we're paying for it? Sometimes that's 3 times the seller's discretionary earnings, or is that, like, what number are you working off of when you say the value of a company?
So we're going to work on whatever the cash purchase price is at closing. So not multiples or anything. I mean, if there's a multiple, but the number comes out at, like, for example, the consumer electronics deal, it's a $6 million deal. They also have a number of earnouts and other post-closing bonuses out there for up to another $6 million. That's not insurable. We're just looking at the 6. Okay. It's the cash that's being paid at closing, however that's valued. There will be, as you get into other types of rep and warranty policies, they do look at, okay, well, what's your multiple? If the market multiple is 10 times EBITDA and you're paying 40 times EBITDA, okay, what's going on here? Okay, those are those conversations. On the TLPE side, it's straightforward.
Okay. Let's talk about we've reached out to you. We're thinking about buying a business or something like that. What's
The
how do
process?
we? Huh? What's that?
Is it the process you're asking about?
Yeah, like what's the process here? Of, like, if I'm reaching out to a business and I see it, like, you know what, I just kind of want something there to ensure that this is right. Can the seller, or the buyer, instigate that conversation with you guys and get the seller involved, or is that normally the seller coming to you guys?
Ideally, the seller is going to come to us. However, the buyer can come and say, "Look, we have this target, and we're aware of this. The seller may not be aware of it. We're aware of this. Can you help?" We have a straightforward application that we need the seller to fill out. The buyer could try filling out, but I mean, like I said, the seller is going to know this stuff. So, and there are disclosures in the application. Do you know of any past lawsuits or anything like that? Best to have the seller do that. So we would get the application. We get a copy of the letter of intent if we can. If you get the purchase and sale agreement, that's great. But letter of intent is helpful. We need the current financial statements, balance sheet, and income statement. From there, that's essentially all underwriters need when we can establish what NAICS class code, industry code is for the business. We can then go ahead and rate it up. Takes, like I said, a day, maybe 2. Put out a proposal if you want. You've got a $5 million company, or here's what a $5 million limit policy costs. That's pretty much it. You get the proposal set up, and then we wait till closing. We will have a draft of the policy prepared, and all the seller has to do is they have to sign the warranty statement within the draft policy that we give at the closing when when all the documents are there. We give you, for the document package, a draft copy of the policy. They just have to sign that as of closing, they are, everything on the application is accurate. There are no changes, and they don't know of any claim. They sign on that. We get paid at the closing right there, and move forward. The underwriters will get a copy of the policy. We'd like to get an index of the data room. If they've got a data room, we don't need the copy of the data room. We just want their index of the data room. And then a copy of the signed purchase and sale agreement, post closing. When we get those items, policies in force, goes forward. The question comes out, well, how long is the policy? Do we have to keep doing this? Do we renew it or anything? No. Policy, the length of the policy matches whatever the survival rate of the agreement has. So if you've got fundamental reps that are 6 years in survivability, policy matches that. If you've got specific general reps, for intellectual property or things like that are maybe 18 months or 3 years, policy matches those as well. There's no difference in price. It's just the policy is designed to match the agreement terms. And so we get it set up that way. And so it's a one-time deal. And as I said, with this glove manufacturer, we did that deal in literally 2 business days. The original SaaS company I did for $5 million, we turned that around in 2 days. It actually took the bank longer to redraw all the documents to have that ready. And then we just go ahead and we do ask that when the documents get signed, they get signed at closing. Don't sign the documents pre-closing, because then if anything is delayed, the policy is triggered at closing. And it happens all the time that something gets delayed a couple of days. We actually had a deal that was delayed just because the buyers, they did not want to be purchasing something on April Fool's Day. And so they said, I know this is Friday. No, we're going to move it up. I don't care. I just don't want to be on record that we bought this on April Fool's Day. So people can be superstitious. That happens.
Yeah, don't they know it's bad luck to be superstitious?
Yeah.
So, I'm a big fan of marketing. I've got a marketing MBA and commercials in general. There's a famous, fairly common insurance commercial out there that says, we know a few things because we've seen a few things.
Mm-hmm.
What kind of claims have you seen inside of this? Are there any like, okay, we paid that, it's just kind of interesting standout type of claims that were paid just because that, it fell within this policy?
Yeah, well, fortunately, TLP has only been out. It just launched on July 1st, 2021. So it hasn't been around long enough to have a string of claims. We actually do have a couple of losses that have been paid. And you had one, it was a chain of Mexican restaurants, and it was an issue on the equipment lease. And so the seller failed to disclose to the buyer that there was an equipment lease out there. And so the buyer incurred additional expenses above and beyond. Policy investigated that and paid the claim. Here's the great benefit. There was another with the same deal, had a second claim actually. But here's the issue with the seller policy is that the policy is written where the underwriters are providing not just the money to settle a claim with the buyer, but you don't just go and respond to the buyer who's probably bringing their attorney over to bring an action against you. You don't go against an attorney with a non-attorney. So what the underwriters do in this program is they provide legal defense to respond to the buyer. They're not going to sit there and just write a blank check. They're going to sit there with the buyer and work out a settlement and try to get it as low as possible in favor of the seller, so that they don't incur too much of a risk. And again, you may have a small deductible, but if the deal can be settled below the deductible, wouldn't that be nice? And so, in addition to the leased equipment issue, there was an employment violation that the restaurant chain had been allegedly using underage employees and working them longer hours than was allowed by the state. This is a chain based in the state of Texas, and so the Texas Workers Bureau brought a violation notice, which totaled about $450,000 in fines. The policy provided the legal defense to respond to that regulatory board, because it was actually the buyer would be on the hook for this. And so buyer, notified the seller. Seller goes ahead, gets the insurance to come in, and the attorneys for CFC under the policy negotiated with the Workers Bureau in Texas. They reduced the penalties, negotiated a settlement, and then paid the settlement. Okay, wasn't disclosed, but I mean, the original demand is $450,000. So they have been there and stepped up. And
you said something really important in there in a split second. I want my audience to get. The buyer would have been liable for those violations. A lot of people think that they do an asset purchase, like an invoice purchase and stuff like that. It severs all, and a new LLC severs all liability. And I was like, yeah, unless you're dealing with government agencies, state agencies, federal, like EPA, because they're going to hold the new buyer accountable no matter what you did, right?
Exactly.
Yeah.
Yeah. And let's step back a little bit just on claims reps and warranties in general, because it's a great point on why these products are so successful. Okay. The buyers of rep and warranty policies are repeat buyers. Okay, they're private equity and other serial acquirers, large strategics, and they're buying many companies. Okay, so what the underwriters did through the whole process is they're going through vetting, particularly in a traditional rep and warranty. They're going through looking at all the diligence reports. They are having an underwriting call with the buyers to say, did you look at this? Did you look at that? And they check off the boxes and everything. So essentially, underwriters and the rep and the deal parties are in the same virtual room together as they negotiate. And so unlike other insurance policies, there's really no gray area on what's covered and what's not covered. Okay, it's a little different with TLPE, but it's still, there's this rigor that's out there that the underwriters are really looking at these deals very closely. So it's difficult for the insurance industry to sit there and when a claim comes in, just say, you know what, I don't think that qualifies as a loss. I think we're not gonna cover that. Okay, any insurance carrier in the rep and warranty market that denies or is at least reluctant to pay a claim, they're toast. I mean, the marketplace will turn their back immediately. So policyholders have tremendous leverage over the insurance industry in reps and warranties. And quite frankly, the underwriters in reps and warranties, and I've spoken to many of them, they really want to get these things right. They appreciate all the business they're getting. These are very profitable programs. And if they get the information from their policyholder on a claim, if it makes sense, they're going to pay it. Because it is not just the right thing to do, but it's just great business for them. And then, you've got a client for life on other things. So CFC, I mentioned that the paper behind the underwriting facility behind TLP has been a traditional rep and warranty insurance market for years. They've paid lots of losses. They know the value of the relationship with the policyholder, and it's never more important than at the time of a loss. And so, they will keep promises made. And I'm in the insurance industry, I'm very, very proud about that.
Awesome. Let's take a step back and let's look at what type of deals. This isn't necessarily for, your mom and pop operator buying another mom and pop operator. This is for, which I guess it could be in some cases. What type of deals is R&W insurance, or in this case, what are you calling it?
TLPE.
Yeah, TLPE. TLPE insurance. What is it? When should a buyer or seller approach it? What kind of deals is this best for? There's
Yeah, I honestly, you hate to say, well, we're open for everything, but I would say, if there's a question, I'd reach out to us. But again, we are looking at purchases of Main Street business that is valued at $20 million and less.
Mm-hmm.
There are financial statements, and again, there's a challenge if it's an adverse sale where companies on the verge of bankruptcy or something like that. There could be some limitations there, in that element. But if you've got a solid company, I mean, we're looking at HVAC contractors. We're looking at companies that are rolling up landscaping companies that are for $1 million. Okay, all the way up through tech. Like I said, other than the regulatory businesses, I think if you're targeting a company, and we're seeing this now funeral homes, bars, restaurants, other types of hospitality, the retail, clothing, retail, other consumer goods, all those types of companies. If it's under 20 million in enterprise value and they need insurance up to $10 million, absolutely give us a look. And, we put together an application and it moves very quickly.
Awesome. We're about 50 minutes in. I want to make sure people know how to reach them. I'll put this up on the screen and make sure, take a quick look at that. Actually, I see I got a double thing. Let me fix something real quick.
Yeah, and my name is pronounced Stroth, like growth, but if you look me up, and it is Patrick Stroth. I'm on LinkedIn, which is great. You also can get on my email, which is my first initial last name at Rubicon INS, short for insurance, so RubiconIns.com. Drop me an email. We can meet. Our team can come out there, send you the application and just a checklist. We've got, and I have a lot of buyers will come to us and just say, we have a target do you have any material or any information we can share? We've got a brochure. We have a case study where we talk about that SaaS company. As a matter of fact, we're going to be adding more case studies coming up, but we will provide that over to you. And I'm always available to get on a call with parties and just talk them through the process and just what it is, what's covered, what's not. And like I said, this is a new experience for a lot of people. And so we understand that. The other thing that's important, though, is my why in being involved in mergers and acquisitions is that I have tremendous respect for entrepreneurs, people that created tremendous value where nothing before existed, and to do anything to help them out as they transition to their next chapter. Who wouldn't want to be a contributor in that way? And this is the way that we can do this. And some of these are, life-changing events. And how can we ensure that this life-changing event gets through successfully without all the wear and tear emotionally that's going to happen? Because these are big, stressful times. And, we want to be that voice of calm and helping you move that risk away.
So just to make sure we just nail this in, if somebody were to take, let's say, two items from the show today, and they listen to the whole thing, and all they really grasp is two things, what would you want them to walk away with? What did you want the audience to say? If you don't remember anything else, remember these two things.
I would say that if you're looking at it, if you're looking at a target and it's under $20 million, bring up the idea of insuring that deal as an alternative to a 10% holdback. Okay, I guarantee you, if you're the buyer, if you bring that idea to the seller, okay, they will happily pay the cost no matter what. I mean, this is an absolute. If you're a buyer, this is at zero cost to you. Okay, if you are a seller, if you're concerned about the risk, okay, this is a great product. It is not required that the buyer accept the insurance. Okay, this is to protect you, the seller. And so if you need that peace of mind and the buyer isn't going to cooperate, you're not relying on the buyer. This is something for you. And you know what? It doesn't hurt to ask and to take a look. I mean, we price these things out instantly. So, I mean, the worst that can happen is it's just not a fit. You just won't buy it.
That's a great concept you just said there. Like, you could be the seller of a business, concerned that the new guy just isn't going to do what he said he's going to do or handle it, and they're going to come back to you for something, right?
Mm-hmm.
And then insurance policy like this can actually help alleviate that fear that if they come back for something, you disclose everything you could. Like you said, this guy asked you, I'm on the buying end. I'm this guy, me, asked you a million questions to start with. But if they miss something and you failed to disclose it, this covers that. I can see where that would be a peace of mind for a seller, right? I think that what I said earlier in the show, when people push back that I can hand it back to you if I find skeletons in your closet you didn't disclose, this would be a huge win for them, because, like, look, I've got this insurance policy. You don't hand me back anything. If it's something I didn't disclose that I failed to, then they'll cover it.
Yeah, so, the two things that the parties want. First of all, they want the deal to close.
Right.
Okay, and deals that are insured, okay, are 9 times more likely to close successfully than deals that are not insured. That comes from investment bankers. That's not from us. Okay, so everybody wants to close, and then for the sellers, quite frankly, they just, I just want an exit. Okay, I've gone through this process. I want out, and I don't want to get pulled back in. I think that would be terrible for somebody as they go and they sell, and then all of a sudden 45 days later they get the company back, and it's like, oh, great, because it's never going to come back worth more. So you want to be able to walk away. And if both parties, there's always some risk. There's always a leap of faith on both sides. However, we can make that leap a little bit, shorter. That's what we're trying to do.
Awesome. Well, I appreciate having you here. We are getting close to the end of the hour here. For everybody that was listening, please reach out to Patrick on either LinkedIn, or I put up his website there also on the site. Those links will be in the show notes, so take a look there. Appreciate having you here. Hang out for a few seconds when we're done, and we'll wrap this show up.
Hey, Ron, thanks so much. It's great to be here, and I really appreciate the opportunity. Thank you so much.
Awesome. Well, that's the show. Hey, it's your host, Ronald Skelton. I want to thank you personally for watching the show today and invite you to call our new hotline, 918-641-4150. That's 918-641-4150. Call us and tell us about our show, ask questions, suggested guests, or even tell me about a business you have for sale, and we'll reach back out to you. Again, that number is 918-641-4150. Call our hotline and leave us some information. Thank you. The Investors and Entrepreneurs Professional Mastermind. The Investors and Entrepreneurs Professional Mastermind combines the traditional peer-to-peer mastermind introduced first in Napoleon Hill's famous book, Think and Grow Rich, with accountability partnering, where your peers help you ensure that you set goals, take actions, and get results. If you want to scale, blow past roadblocks, and achieve success faster than you might think is possible, I suggest you take a visit over to TIEPM.com. That's TIEPM.com and check out the Investors and Entrepreneurs Professional Mastermind.